Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to a Wiser Retirement podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Missie Beach. Hey, Missy.
Hey, Casey. How are you doing?
Good. So today we're going to focus on creating or investing for the long haul. And, you know, I feel like we only talk about this when the market's really down. And people, not everybody, but people want to go to cash or they're tired of losing money. But, you know, we've had a pretty good 2023 so far. And I feel like that, you know, some of us are still waiting for the other shoe to drop. I mean, not me, but some people are. And, you know, we're still supposed to have this great big recession in 2023 that hasn't happened yet, right?
Right.
So ultimately, though, you know, you have to stay focused. Like, is there a recession this year? Does that matter to your retirement portfolio?
No.
I mean, I really don't think that it does. If you've done proper planning.
Exactly. And if you're here working with an advisor, it certainly doesn't matter because you've accounted for all that.
Right.
And that's what we remind our clients over and over, that it doesn't matter, these little blips on the radar, because again, you're in it for the long haul.
So there's also this thought that you can beat the market, that you can make money if the market's going up or if the market's going down. And there are strategies to make money when the market's going down. Your risk level just goes through the roof, because if you catch it the wrong way, then you'll lose more money than you just holding the market. Obviously, there's some people that say, "Oh, I know that the market's going to fall, so I'm going to go to cash. I'm going to wait for it to get better." But really, what they're talking about is their feelings.
Oh yeah, it's all emotional, and
there's no data. There's no data behind it. I mean, they might think that saying the market's going to fall is data of some sort, but that's not really the case. So really, you know, there's a couple of things. One, we've talked in prior podcasts about airline pilots, and they've had this big push in their 401k plans to be managed by a third party. They're charging 0.5%, which we've talked about in the past, equates to $2.5 million in fees over the average lifespan of a pilot working. And that's true for others. It's just that pilots have bigger 401k plans because companies are putting so much into it in addition to what the employer is putting in. So part of my reasoning for thinking that's a really bad idea is that not only is it the 0.5% fee, but it's also this concept that the 401k plan, the brokerage link that's attached to it, that somehow a manager is going to be to outperform the core asset classes. And I referenced this SPIVA report, and people have been asking, well, what's the SPIVA report exactly? I mean, where does that come from? So it's actually derived from S&P. So S&P Dow Jones Indices. And the report is produced every 6 months since 2002, I believe.
Yeah, 20-year history now.
And what's interesting is there's a lot of people who have reports. You can find reports on the internet that show you that active is better than passive, actually.
Oh, sure.
But
you can manipulate any report.
But there's biases in the system or in the report. So one of the is the survivorship bias. So if you only count the actively managed funds or the managers that survive, then obviously you're going to have a bias toward the best funds versus the index, right? You have to also count the funds that don't survive.
Yeah. Anyone can have a great run for a couple of years, but if you're out of business, who cares?
Which is very interesting, because if you look at the number of funds that that survive, it's very, very low. In fact, I don't have. I'd have to do the quick math, but percentage of funds that do not survive. How about that? So for like U.S. large cap funds over the last 20 years, 72% don't survive.
That's incredible.
They failed.
Oh my God. Over 2/3 failed.
Over 2/3. They did such a bad job they went out of business. Now there is they could merge. They could have different classes and they can merge classes potentially. So maybe we give them a little bit of benefit of the doubt,
sure.
but
Maybe
that's still that's still a really long time.
And all those investors paid for those failures.
Very true. Small cap funds and 61% failure. So really, in portfolio management, there's this whole theory that you're going to have small cap, mid cap, international space. You're better off having active management, and you buy the S&P 500 for domestic. And the data doesn't show that either.
I know. And you're right. A lot of advisors will go down that path thinking they're going to add, a little bit of alpha there in those other asset categories. But you're right. It's just not there.
Right.
Warrant the extra expense.
So then you go and you look at a lot of the accounts that we get in, and it's actually a lot of active managers do the opposite. They're picking individual stocks domestically, and then they're farming out the other asset classes because they don't know anything about those, I guess. And really, if anything, it should be the opposite potentially. So another thing is reports need to use like apples to apples comparison. So for example, if my small cap growth fund did really well over the last 3 years, and I compare that to the S&P 500, that's not a fair comparison because the companies that I'm investing in my fund don't even show up on the S&P 500.
Right.
They're two separate asset classes. It's comparing my Ford Focus to the Maserati. Right?
Unequal comparison.
Unequal comparison. So in the Spiver report, they do have it's not just everything versus the S&P. It's the fund versus an appropriate index that should be tracking that.
Yeah. And one thing that I thought is interesting about the Spiva report is that they really tout 3 factors to show that it's very unbiased. And the first one is that it's published every 6 months. So it's got a regular schedule that all this data is run through. So it's not like they cherry pick time periods and say, hey, during this 8-month period, these active managers outperformed, or underperformed. So it's regimented. And then secondly, they'll report and highlight when active managers do outperform. So it's not biased to show just when active managers fail. It's going to highlight when they do outperform.
Right.
And usually that's just short-term time horizons. These active managers aren't going to bank outperformance over a 20-year time period. It might just be like a year or 2 years. And that comes into play when we have new clients coming into Wiser and they're like, hey, my portfolio's been awesome. Look, why would I ever switch out of this to your diversified model? And I'll look and I'm like, well, you're in all stocks, Are you comfortable with that much risk? Because what if we go through the credit crisis again? We're going to test your portfolio. And so they're like, maybe. And then the third factor that it's unbiased is it's all publicly available data. So it's not like any secret sauce. So this is real legit data that's showing active management isn't paying off.
And you see that with using your example, mutual fund advertisements, they typically will pick a window of time that they performed really, really well. And statistically, that's very possible. I mean, on a 1 year time horizon, you have let's see, what is it? 48% of funds outperform the S&P 500 over a 1 year time horizon. That's you could not easily, but you could sort through and find good managers that would be able to do that. And so usually what you see advertised is 3 years. Well, 25% of funds beat the S&P 500 over 3 years. That's pretty good.
Sure, but
Right?
how do you know which ones over which period and
That's
when
true.
to get in and out of those great ones?
So there's another report you could layer on top of this, which is a Morningstar report that actually shows active management does better than passive management, but in order to make it work, you have to purchase a fund of a manager who's underperformed for the last 2 years, because statistically, to keep their job, they're going to have to outperform for 3 years. Then when the fund's really, really hot, you have to sell it
Oh, yeah, at its peak.
at the peak, and then you have to move it to a different fund that has been underperforming in the same asset class, not different asset classes. So
Yeah, tax loss harvest.
correct. So the wrong way. So you have to you have to basically buy high, sell low,
Yeah.
and you have to have like 3 managers that you're choosing, and you move from one to, and it's not practical. It's
No.
definitely not practical in a taxable account, because you're being
God.
cap gains every time you sell
Exactly.
these things.
Like
and
you
then,
said,
and
the
you have to find,
reverse.
and you have to interview managers. No one does that. I've never talked to a retail investor that said, yeah, I interviewed this manager.
No, it's dumb luck.
Right, exactly. So yes. So to the point, you have to find the fund, then you have to keep the fund. But ultimately, though, if you look at it over a 15-year time span, and the PDF report goes into 20 years, but the graphics, and we'll put this all in our show notes. But the graphic for the 15-year time period is 6.6% managed to outperform over 15 years. Now it's getting really, really hard
Yeah.
to find the right manager. So then it comes back to, how do we invest for the long haul? Well, I like winning. I hate losing. Right? So,
I'm with ya.
so in the end, you want to pick low cost index funds and get your allocation correct. So the S&P 500 should be a large portion of your investment. And then you diversify around that with foreign, small cap, real estate, right? And then you add, you can add other things like, hard real estate as your assets grow. But realistically, this is how you beat the percentages over the long term. And so what? Over 20 years, it's 2%, by the way. 2% of the managers actually beat. So over 30 plus years, we're going to have data for that eventually. And it's margins are going to get smaller and smaller. So you're going to win. It's a long game. And you got to keep your costs low. The average cost of our portfolios here are 0.08%. And that's because we have one fund that is real expensive.
What, the emerging markets?
No, actually that one's really cheap.
Okay.
It's the Pacers ETF.
Oh, yeah.
So it's a value play with a little bit of a twist that we added to our portfolio, hopefully to find a little kick there on the value side, because value has been sucking wind for over a decade. But ultimately, we're not deviating much from those core asset classes. Now there's some things you can do to try to juice up the portfolio. Technology fund would be a good idea. Or just maybe even leaning more toward growth for more aggressive portfolios. Even like the people that load up on value dividend stocks, they've been really disappointed for almost 15 years.
Yeah, exactly.
I mean, versus the overall market, versus the S&P. So it's there's no secret sauce when it comes to investing. That's why we're a financial planning firm.
Exactly.
We manage assets. 90% of our revenue comes from asset management, but it's just how our world works. People pay us a percentage of assets under management, but we spend 75% of our time doing the planning and keeping people on the tracks.
Exactly. And when you're talking about, over 18 years, what do you say, 2%?
2%, yeah.
I think about all these clients and the fact that so many come into us and they're like, yeah, I haven't touched this account since I left that job 15 years ago. I haven't touched that account in, probably 10 years.
Right.
People are not keeping up with their portfolios and their allocations. So maybe even if they thought it was this great fund mix when they bought it, chances are the majority of clients are not keeping track of it and rebalancing and, researching these active funds. So it's not going to pay out.
That's where the outperformance comes from is really rebalancing at the appropriate times.
Yeah, and that's not occurring.
No, because people really don't know when or how to do that.
No, it's like the people going to cash, and I say, well, you have to be right twice. Sure,
Right.
You feel like something ominous might happen, and maybe you're going to go to cash now, and then maybe something doesn't happen for a whole nother year. So, yeah, technically you were right because you got out because the market might decline, but you've missed out on that opportunity cost of staying in until it went down. And then, so when are you going back in?
Right.
When are you pulling that trigger? And then nobody knows.
When they feel good. And the problem is they feel better when the market's high again. So they missed
Exactly.
out on the whole thing. And you don't also understand that if the market closes at Dow 30,000, it could open the next day at Dow 31,000.
Good point.
And so if your exit point was 30 and you're going to get back in at 30, and let's say it went down to 25 and now it's back, you're going to miss you're going to miss that. There's no way to
Right
capture
there.
that.
Yeah.
And even aftermarket trading, you're not going to be able to capture that. It just opens higher. It's like, the product that you wanted to buy was $100, and the next day you walk in the store and it's 120, and the owner's it's like, sorry, this is today's price.
Exactly.
There's nothing you can do about that.
So that's why I tell people stop trying to play the game, because
Right.
you don't have to play the game. And if you just stay invested for the long haul, the market has demonstrated it's going to return wealth for those that stay well diversified over the long term.
Right.
So if you know that historically that's occurred and we see no reason that that's going to change, don't mess with what works.
Yep. And it works. It works because the S&P 500 is, I call it a self-healing index. It's ranked by market cap. You don't get on the S&P 500 unless you're approved by the committee. So it's 500 of the largest investments in the U.S. It's not. It's not the largest. So there are some large companies that don't meet the criteria. One is profitability. You have to be a profitable company. That's why Tesla was delayed in getting on there. They weren't making any money. They showed up in like the Vanguard Large Cap Index Fund,
Yes.
but they didn't show up in the S&P 500 until they had profitability. So you have some safety in that versus other indexes. But you have to understand that, what is it, 10 years ago? I think ExxonMobil was the largest holding. It may have been 12 or 13 now. But now it's Apple. ExxonMobil is one of the smaller holdings on the S&P 500. So it's gonna be ranked. Yes, it's a little tech heavy right now, but shouldn't you be tech heavy right now?
That's the world we live in.
Yes,
Yeah.
absolutely. So it gets a lot of criticism. Some people say you should equal weight it instead of market cap weight it. Equal weight works well for a time, and then it doesn't. Just like active strategies work well for a time, and it doesn't. Yeah, there's a local wealth management firm here in town that was known as the value people, dividends and value, and they almost lost their business. They underperformed so greatly for almost 5 years. People were leaving.
Yeah.
And finally they were like, okay, maybe we need to shift our strategy a little bit, right? And they started reworking their portfolios. But we're just really just talking about the S&P 500. But if you want to look at other asset classes, for example, emerging markets, 94% of fund managers over 20 years underperformed.
Oh, yeah. But I feel like that's such a wild card.
And that costs you so much money.
Oh, yeah, those are expensive.
International small cap funds, which we have a sliver of our money in here, very, very tiny, but 84% underperformed. That's actually the best asset class for active managers. It would be small cap international. Just international, so the developed countries, 94% underperformed over 20 years. Global funds, those managers can invest anywhere and do anything. The go anywhere fund, and they all tout that. 89% underperformed over a 20-year
yeah.
period. I mean,
that would be the most challenging category, I would think.
Yes.
The go anywhere. How can you be experts in everywhere?
Right, because your benchmark becomes ACWI, which is basically the all-world index. So it takes the entire world, market cap weights it, and it obviously has a lot in international. And you have currency plays that now go into effect, and it's an uphill battle for sure. What's interesting is I think the best over 20 years, the best active asset class to find a manager was real estate.
Okay.
And that somewhat makes sense, but also real estate active management can be very specific. You could have active funds that only focus on residential, only focus on commercial, or really the biggest one right now is commercial or public warehousing.
Oh yeah. Mm-hmm.
So that's a big that's a big category now. So I mean that makes sense. But again, all these other asset classes, even if you go to large cap growth, now think about this: large cap growth. That's going to be your Apples, your Googles, any company that's continuing to grow. Not Coke. Coke is a value company.
Yeah.
Pepsi's a growth company though.
Really interesting.
When you travel internationally, there's very little Pepsi. There's tons of Coke. Pepsi could expand their footprint.
You're right. True.
So you think, oh man, a manager that's able to go out there and find these growthy companies, I think that would be fairly easy. 99.2% failed to beat the growth index over 20 years.
Wow.
You're better off buying the S&P 500 growth index than you are finding any active manager.
99.
Now, active manager does not necessarily mean mutual funds. It also means your Edward Jones account, your Morgan Stanley account, because a lot of those are SMA, separate managed accounts. So,
I love to ask clients that come in with the Edward Jones portfolio, like, explain to me, like, well, how did y'all decide on this basket of stocks? And they're like,
right.
No clue.
But they have a lot of them.
Explanation, oh no, they just thought these were appropriate, And I'm like, well, how do they decide how to get in and out of one or the other? Oh, their research.
Yeah.
Okay.
But it's not even the individual advisor's research. It's like, it's company. He's just a salesman or she's just a salesman. Yeah. Don't get me started on that.
Okay.
That was probably the worst category. Large cap core. So that core means growth and value together. 98% failed to beat over 20 years. So there's just not a compelling argument that why you should be spending 1.5% in management fees on to an individual fund, or paying in some cases, these brokers will charge 5.25% interest to buy into the mutual fund. Yeah. So you're losing 4.25%.
Those are the hard ones to swallow.
You lose 4.25% just to buy it. And then after that, you have to pay usually around a 0.9% management fee on top of that.
And that you're not going to see on your statement. It's not like you're going to see, 0.9% was paid to this fund manager. It's just embedded in the cost, and
Correct.
It reduces your total return.
Right.
So that's where people don't know what they're being charged.
Oh, absolutely. Yeah. I mean, I've had people tell me that they don't pay anything for asset management. That their broker said, no, you don't pay me. These companies pay me.
Yeah.
Well, who do you think pays the companies? You do. You pay the companies, right?
Yeah. Well, and Casey, even within 401k plans, granted, they've gotten a lot better over the years. But still, we run across 401ks every now and then that just have an awful set of investment options with really expensive underlying fund fees. And so for our clients, we try to find the best of the worst, but it's still something to consider even within your 401k.
Yeah, with all the class action lawsuits on 401ks, they still seem to be a lot of mid-level employers that haven't read the newspaper. I mean, it's bad.
Yeah, you're right. The big corporations have gotten on board.
If you're at a big company, your 401k plan is the best it's ever been.
But small employers, you're right. That's where we're seeing it. Funds with still like a 1% management fee. And so we're trying to make the best
Well, that's
out of
because
the
you
worst.
have guys like American Funds or other salesmen that come in and they say, I can give you a free 401k plan. So the company isn't paying for it. And the business owner is probably really good at whatever they do, but not so good at the finance side.
Right.
And they say, oh, it's a free plan. What I do, I mean, actually, those plans sometimes can be over 2% in fees, and sometimes they'll still collect the 4.25% commission if it's an old school plan, which is crazy on your 401k plan.
Yeah.
So that's a lawsuit waiting to happen. But what I do is when I go in with a 401k plan with a small business owner, I say, you're going to be the biggest benefactor of this plan. You need to pay my fee directly to me and do not charge a penny to the employees.
Oh, yeah.
And I've actually turned away some 401k plans over the years because they're like, no, the employees can pay for this. They
can
want this.
shoulder that.
They can pay for this. And I'm like, yeah, but when it comes to profit sharing, you're going to be you're the most expensive person to the corporation. So your percentage is going to be so much higher. And then the money that you're deferring on taxes is so much more beneficial to you than it is your employee.
To be, this tiny slice of the plan.
Yeah. I don't understand. You're like, well, it hurts my margins, and so does not having quality employees. That hurts your margins too.
Yep, employee retention.
So it's just we don't do a tremendous amount of 401k plans here, but the ones that we do, I'm proud of our business owners for looking at this way of taking care of their employees, not taking advantage of them.
Yeah, passing on the cost.
Exactly.
Unnecessary cost.
So, what this comes down to is there are going to be market ups and downs. There is no secret sauce to investing. You're not going to be able to go to cash and then come back in and buy something else later. There are a few people who have stories like that, and I guess they got lucky.
That's it, lucky.
But a lot of people move the cash because they're scared, and then they miss out on the rebound. I remember after the financial crisis, we added a lot of clients in 2010 who had $500,000 who used to have $1 million.
Yeah.
And they should have rebounded by 2010.
Yeah, but they were still sitting in cash.
They were still, and they sold in March of 2009, which is like the worst time to sell. That was the bottom, right?
Oh, yeah, that was the bottom.
So when you think about, okay, so how do you win at investing? If you're hiring a financial advisor, that financial advisor should not be actively trading your portfolio. That financial advisor is there to build a comprehensive financial plan, which most advisors don't do these days. They say they do financial planning, but all they really do is retirement planning.
Like a one-time,
data like
in, data out.
You're saving this much. You should have this average return, and it'll equal this. That's a time value of money calculation.
Here's your number, Casey.
Yeah, right. In fact, we don't even need advisors to do that. You can use some pretty cheap or even free software or websites to figure that stuff out.
Well,
you don't need an advisor.
No, you can make it say whatever you want it to say. Really,
that's true. You can fool yourself. So what you have to have is an advisor that's focused on comprehensive financial planning. What about your property and casualty insurance? What about your estate planning? How about your tax planning? Not just for today, but how you're saving so you can be properly set up for taxable, non-taxable, low tax investment withdrawals in the future, right? You have to do that now. That's not something you figure out in retirement. You have to do it now to get ready for retirement. If you're in retirement, cash management. So, the monthly withdrawals, where do they come from? How do you set up your portfolio that if you take a beating in the market, that your lifestyle doesn't change? Right? These are all important things that a good financial advisor is going to be able to bring to the table. And it's called fee only.
Absolutely.
Right? Not selling any products.
No.
A fee only platform. Vanguard calls it advisor is alpha.
Oh,
and
yeah.
by their estimate, having a good fee-only advisor adds about 3% to your rate of return to your portfolio every year.
Yeah, that's a great study.
The reason why it adds 3% is because as humans, we tend to do, especially when we're by ourselves, we don't have proper guidance. We tend to do things like switch our investments at the improper time, not necessarily always go to cash, but just make little changes along the way that probably aren't best for the portfolio.
Right. Or sometimes it's inaction on the part of the investor.
Yeah, head in the sand.
Yeah. The emotional side will just say, oh, I'll skip this one, or, you
Right.
know, it'll rebound.
Exactly. So anyway, stay focused long-term in your investments. We'll link to the Spiver report in this podcast, which you can view. Episode 170 is a good one. How much money do you need to retire? Episode 103, your pre-retirement checklist. That was a fun episode. I think that's when we did the like a rocket launch countdown for that one. We also have a YouTube channel, also called A Wiser Retirement. Are annuities a good retirement strategy? I actually had a person in here yesterday, Missy, asking for annuities. And
Asking for.
yeah, I sat up in my seat and talked very sternly.
Good. Did you shake your finger?
I did not shake my finger. I thought that might be rude. Are annuities good retirement strategies? There's a video for that linked here today. Should retirees get out of the stock market? We did that one back in 2022. Will a stock market decline kill my retirement? Actually, no, it's a great opportunity. Keep investing. Anyway, thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode show notes. Thanks for your time, Missy. See you next time.
Stacey.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley.